In this episode of On the Tape, I welcome my longtime friend Meredith Whitney to the pod. I've known Meredith for almost 30 years. And for those not familiar with her, she, along with Vincent Daniel, worked with Steve Eisman back in the mid-90s at Oppenheimer and later went on to make some bold, correct calls, including the infamous 2008 Citigroup dividend cut call because of mounting losses in their subprime portfolio. Not too long after, it was Michael Lewis that approached Meredith first about who on Wall Street had been successfully navigating the GFC, and Meredith pointed Michael to Steve Eisman and our team at Front Point, later depicted in The Big Short. Throughout her career, Meredith has built relationships in both public and private sectors that have proved to be valuable, especially in today's climate. After a few successful stops, which included both managing institutional capital and working at startups, Meredith returned to her roots and founded the Meredith Whitney Advisory Group, which she runs today, providing thoughtful, macro, and strategy-driven research to a broad audience that includes both investors and C-suite executives. Never in my investment career has this been more important to understand, not just the fundamentals of a company, but the macro and government policies that influence their businesses, and Meredith gets it. Meredith continues to see ample liquidity in the credit markets, providing support in the consumer lending markets. We touch on government policy as it relates to Fannie Mae and Freddie Mac and what's ahead there, the state of the U.S. consumer in a K-shaped economy, and fresh off her op-ed in today's FT, we talk about the state of the U.S. housing market and why the demographics around it are secular and not cyclical. But before we get to Meredith, I often get asked, Danny, what does this current investment environment remind you of? Any similarities to the GFC, et cetera? My answer is often a little bit of everything. But that has shifted, in my opinion. Over the last few months, and having been on Wall Street and trading during the Dotcom bubble in 99-2000, I think this cycle now not only rhymes with 99-2000, but it's very close to mimicking it. When I see things like companies converting to crypto treasury entities and then trading at a premium to the underlying crypto, with leverage, I might add, it reminds me of the businesses converting to dot-com strategies back in 99 and 2000, and in some cases, just creating a website like pets.com to try and join the party. And when I see stocks like Opendoor and Better Homes and Finance move like they are on outlandish assumptions and price targets, I get concerned. The vendor financing and investment stakes that NVIDIA has been conducting over the last several months are eerily similar to what Lucid and Nortel did during the dot-com bubble to try and ensure the demand for and ability to buy their product would continue regardless of who was paying for it. I'll remind people that the same way the internet was exploding onto the scene in the late 90s with the perceived endless demand for all things related to high-speed fiber optic networks is similar to what we are seeing today in the AI arena. Michael Lewis's book, The New Thing, was about the dot-com boom and bust and was about Netscape and others that had disruptive technologies and business models that were reshaping the economy. Does that sound familiar? I know that the last thing that a bullish investor wants to hear during a cycle like this is, that stock's too expensive. Oh, and it can't go higher from here. I get it. But at some point, math comes into play and you realize that the denominator, or the TAM, is not infinity. At one point during the dot-com bubble, the CapEx and supposed demand for fiber would have equated to enough fiber to circle the earth many times over. And it became a game of musical chairs. There is no doubt that AI is real and here to stay, but I'm just asking you to do the math. With that out of my system, please enjoy my conversation with Meredith Whitney and hang around for my NFL picks at the end of the episode. Welcome to the On the Tape podcast. I'm your host, Danny Moses, and today I welcome my longtime friend Meredith Whitney to the pod, founder of Meredith Whitney Advisory Group. Meredith, you were on the OG On the Tape pod back towards the end of last year, and a lot of the things that you talked about then are now happening now, and we're going to get into that. But let's start with front and center op-ed in the Financial Times, right? Nice to have you on the day that you put something like that on, which is about housing, which is huge focus. And let's just start with that, and then we're going to work our way around the financial globe here.
Sure. The focus of the op-ed was on the fact that in terms of existing home sales, this is going to be 2025 is set to be the worst year in terms of the slowest year in terms of existing home sales in well over 25. The market is really gummed up, and a lot of people are wondering why, coming up with a lot of different explanations. There hasn't been enough home building, and that's just, in my opinion, just not the entirety of the story. The entirety of the story includes the fact that this housing market is very different from housing markets of the past. And the main reason is because seniors own such a high percentage of homes, well over 54%. I think it's actually towards closer to 60%. The stated number is 54%. I think it's closer to 60% with second homes and whatnot. And they're not selling. So they don't have financial pressure to sell. They want to age in place. So not only do Redfin and AARP say that seniors want to age in place, but they also don't have the financial strain. Now, owning a home for the past couple of years, has been much more expensive than renting, largely due to increased homeowners insurance, property taxes, and just overall general inflation. But there's one area where a lot of seniors are seeking relief is through tapping the equity in their homes. So there's 36 trillion of equity built up in homes, and they're tapping into it. So if you look at the whole pie of home equity loans, seniors represent 41% of it, which is, contrary to everything you believe, because typically when you get older, you have less debt. So just throw out some stats. 79% of seniors own their own homes, and 74% own them free and clear, do not have any mortgage. But a couple of things are happening. So they're tapping into traditional revolving HELOCs. They're tapping into first mortgages. So 60% or closer to over 60% of the cash out refinances were done at higher rates just so people could access the cash in their homes. There are also a bunch of new products coming out targeting seniors, interest only, more interest only home equity loans. One product that's fashioned after a very popular product in the UK, retirement investment only. So senior market is really the golden goose for consumer lenders. And because of that, I think you're going to see a housing market stay basically gummed up, stuck, going nowhere for the next few years.
New mortgage products, where have we heard that before? So it's really interesting in housing because global financial crisis, a great financial crisis, whatever you want to call it, in 2008 kind of changed the way that next generation of homeowners, to your point, younger ones that aren't the largest percentage of owners of homes, how they think about owning homes and so forth. And then obviously COVID changed the way that people acted by working at home. And now this is a result of all of that. You talked about this last year. You talked about the explosion, possible in second mortgages and HELOCs and things like Rocket Mortgage, which you had identified early as a beneficiary of all of this. And so where are we right now in kind of that tabbing cycle? Because as bearish as I always want to be on the consumer, we're going to get to kind of the K-shaped economy here in a bit. There is, it's a built-in almost savings to a degree. Yes, you have to borrow it against, future ownership. But talk about that, where we are in that cycle, and how much more. Are we in the second inning, third inning of this potentially?
It could really still be the first inning. So it was the summer of 24 when I noticed, because I look at this so closely, that revolving home equity, which had been a product that had been shrinking for 17 years, began to grow, reversing a 17-year trend. And to me, that was stunning. And it was also corresponding with one other trend, which was private credit, which is this massive market, was now coming after consumer duration loans. That's anything, let's say, not a credit card, but a personal loan, and certainly a mortgage. They want thick duration product. And you just saw so many deals being inked with private credit in terms of forward purchase agreements. So what I saw was so much liquidity coming into the market. And because home equity had been a product that had not been popular, banks have been distancing themselves from that product for so long, it hadn't been on the minds of consumers. So consumers are only now getting solicited and becoming comfortable with tapping their equity. Now, seniors are familiar with this product, so maybe that's why seniors are much more receptive to the product, but also seniors own a disproportionate. So the population of people over 65 is still, just 20%, yet they own over 54% of homes. So you see how concentrated the system is. I think this is going to be a major theme, growing momentum for the next several years. I'll give you an example. So Rocket is the third largest issuer of home equity and the number one issue of a second mortgage, where you get a fixed second mortgage. You can keep the original low rate on your first mortgage and get a second mortgage, fixed dollar amount and fixed rate. They're on track year to date. They're over 57% in excess of what they originated last year. And I think next year is going to look the same way. So if I look, a Rocket Mortgage and Mr. Cooper are the merger deal is supposed to close in the fourth quarter. Mr. Cooper's done close to 2 billion well north of 2 billion in securitization so far this year. They didn't do anything last year. So between the two of them, they're just getting started. And there's a laundry list of companies that are doing this. Banks, to a certain extent, Bank of America and Citizens and Fifth Third are active in the market. But really, it's when we first met back in the 90s, the monoline consumer finance company really dominated consumer finance, and that's happening again. So many private companies that people don't know about are also originating this product. Very, very early stages.
Yeah, so when the Fed cuts rates, certain things that has an impact on, obviously, HELOCs being one of them, any type of floating credit card debt. But you're right, and you've been talking about this for a long time, the amount of private credit that's out there chasing these loans through securitizations not only creates a smoothing mechanism to a degree, but you're also getting the benefit of the Fed cutting, so you certainly could see more there. All right, let's take a step back, because one of the things that you have done over your career is to align yourself or get to know the regulators. I mean, during the housing crisis, obviously, you knew everybody. From Sheila Bair to Fed governors to everyone, you were really involved. And now the biggest topic related to mortgages and housing is Fannie Mae and Freddie Mac and what's going to happen there. And you're down in D.C. a lot, or you live in D.C., I should say. So you're down there a lot, so you have a sense for what's happening. Where are we right now? Let's go back to the inning baseball call, since we're entering playoffs here, probably without the Mets. Sorry, Vinny. Where we're going to enter here in the cycle, and what to look for here going forward on Fannie and Freddie.
Well, Fannie Freddie has been sort of this ongoing saga for, upwards of almost, 18 years. And I think during the last Trump administration, there were rumblings that they were going to be privatized. That kind of, because of COVID, got kicked to the curb and then went literally on ice during the Biden administration. So there's a lot of hope that something would happen early days. I think something, if I had to say, I think something gets announced at the end of this year, if not very early next year, that they're going to, in fact, the government's going to steadily release them from conservatorship, and there's going to be a mega public float of these companies. If I had to say, I think that could be, obviously, of course I could be wrong with any of this stuff, that Fannie Freddie gets smushed together because there's a lot of synergies. There's a tremendous amount of cost saves. This deal has to be attractive to investors because of the sheer size of capital being raised. And I think that they're going to model some of this off of past experience. So I think if you want to be a student of how the government got out of AIG, that will be a proxy for how the government will get out of Fannie Freddie. But that, to me, is the only issue in mortgage, or one of the very few issues in mortgage to talk about going into 26, aside from home equity, which I've been focused on for, as you said, well over a year.
I've heard mixed answers to this question. Is what happens to mortgage rates in general as a result? There's a lot of concern, obviously, that with, quote, without the explicit guarantee. Now, there's still an implied guarantee. You pay a G fee, right? You're still going to be paying that to the government so they can provide support. But how do you think that works its way through the markets in terms of mortgage rates staying contained with these two companies?
It all depends on what people think about growth and what people think about, like, the deflation coming from AI. So I think it's beyond just Fannie Freddie. I don't know that Fannie Freddie necessarily compete so much, so aggressively together that they keep rates low. I think that there's still an implicit guarantee. I think they're going to make it. I think that the administration has already said the implicit guarantee will continue. So I don't see that much of a risk of disruption, particularly with, a real emphasis on deflationary pressures, keeping rates low.
All right, let's talk about another area that you focus on, which is the U.S. consumer. You wrote a report, in September, actually last week, called The Impending Slowdown in Gen Z and Millennials Spending. You titled it Avocado Smash, which I thought was great. Talk about that, and we're going to get into the K-shaped economy off of that. So
One of the two things that have been driving the economy insofar as consumer spending is concerned: the very high end, and then what I call the avocado toast generation, which is older millennials, older Gen Z and younger millennials. It's really 24 to 38. And they have been spending dramatic. They don't own, here's the commonality: they don't own homes, and they're spending what they earn for the most part, and they're spending on experience. They're spending it on things that I wouldn't spend. A $20 avocado toast, a $10 French press coffee. Those are things that they feel entitled to. They've had so much money because what I think was underappreciated was the fact that COVID stimulus checks ended in 2022, and but financial forbearance for student borrowers has continued up until October of 2024. So technically it ended in September 23, but there was a very, very generous on-ramp period where if you were delinquent or didn't pay, it wouldn't go on your credit record. It wouldn't be reported to the credit bureaus. Sure, you'd accrued interest. So people didn't pay for that on-ramp period. And then when people have started to pay after October 24, there's been this, or the few people that have, I think only something like 34% are current. Over 11% are seriously delinquent. What's happening started to happen in August is, for the people that have not paid, either seriously delinquent or in default, they're going to start to garnish their wages. So over 54% of student debt is owned by the avocado toast generation. And they can say, fine, it's very difficult, as you know, psychologically, if you haven't paid a bill for 5 years, the tendency to either have saved money up to be able to pay that bill, or the willingness to pay that bill is very, very low. So they've been spending. When they start getting their wages garnished, I think that's going to be a real sting to this group that has been carrying a lot of the spending in the economy. And a typical student debt payment is $200, $300 a month. But the government, the Department of Education, is authorized to garnish 15% of your wages. That works out to an average income of, let's say, $64,000, $65,000, which is the average college graduate income of that age cohort, to about $700-800 a month. That's a big sting. So I think that, and I expect spending to come down in a lot of those areas. I don't think it's coincidence that restaurants like Sweetgreens, Cava, Panera, Chipotle have all seen declines in same-store sales. That's where this demographic, the avocado toast generation, is spending.
Seniors tapping into their homes, they're not using that money to go to Sweetgreens, obviously. And you also mentioned on this that healthcare premiums, even for people that are employed, are going up dramatically as well, which is obviously very underreported as it relates to inflation. But talk about that, because those are the biggest expenses, obviously, that people may face. So.
Yeah, so this was the American Rescue Act, which subsidized people's healthcare premiums. And that runs out at the end of this year. That is going to be a doozy. And I think the double whammy between student loan garnishments and increased premiums, which equate to about, again, another $300 a month. And 52% of all Americans are privately or independently insured. The rates for that goes up. Also, the rates for corporate insurance go up across the board. That will be one of the biggest inflationary, stinging points next year. So all of the services, so then the place to watch on inflation is going to be services, because healthcare, just by the math of the expiration of the American Rescue Act, healthcare premiums are going to go up. Property, homeowners insurance is going to continue to go up, because the replacement value, the replacement cost of all the imported items that go into home building is going to go directly through to the consumer. And then obviously auto insurance. So I can't see how you get inflation out of the picture for 26.
Yeah, and you're right. And the more people take out of their homes in terms of mortgages, the more those companies will require a higher amount of insurance, at the same time. So one of the things that you're watching, so you're obviously in the camp that the economy, it's bifurcated, but it's definitely slowing, and then you're going to see unemployment rise. I know you've talked about, we were down to 3.8, 3.9%, working our way here into the mid fours. I'd imagine you see a trajectory here to kind of get towards the 5%, by the end of the year. Talk about that and talk about whether you think that the Fed is justified in cutting right now, or the stuff you just talked about that is inflationary, where we sit. Are we looking at a kind of a stagflationary type of environment here going forward?
Yeah, so the stagflation makes the Fed's position really difficult. So you see cost inflation, but you see the employment market really weakening. And one of the reasons why I see employment heading so much higher is because you see the slowdown in spending in leisure, hospitality, retail. And retail's been better back to school, but that's off of a very low level. And that's 20% of employment. Those three categories are 20% of employment. And so the only way, and also with any type of goods inflation, they are going to pass a little back onto the consumer, but they're going to eat it by ways of cutting employees. And for that reason, just the math works out to a much higher unemployment picture.
All right, so I got to push back on one of the reports you put out. It's correct, but I just want to get your thoughts, I should say, on one of the reports you put out. So in August, you talked about the K-shaped economy, which you're kind of describing here. And you also at the same time acknowledged the amount of private credit and people chasing, we just talked about a few minutes ago, asset-backed lending products and so forth. So one of the issues that I have a problem with is, one of the names I have a problem with is Upstart. And I think Upstart is right in the center of all of this, of these counter trends, right, that are kind of coming in. And I'll put a firm to the side for a second in the buy now, pay later. Let's just talk about Upstart. And for people that don't know what Upstart is, it's basically an online lending platform, basically gives consumer loans. They're going into home equity. They're in auto now and doing some other stuff, but it is the low-end consumer. And they are dependent upon credit in markets staying frothy and people and wanting to buy that product and whatever. You and I both know, Meredith, what the beginning of the end was in 2006 was when Wall Street started to pull the warehouse lines from the mortgage companies because they saw credit start to deteriorate. So where do those two things meet in the middle? And I'll just say one extra thing on Upstart here, and you were right on this thing and I was wrong, is that it's a financial company and it's not a tech company, and it trades at 10 times book value. So at what point does it matter, Meredith?
Oh, well, let me go back a little bit further because when I came into 25, I thought that you'd get a leveling out of a K-shaped economy, specifically because there was so much private credit coming into the system that the first thing personal loans and home equity, first thing home equity money is used for is home renovations. The second thing is debt consolidation. So I thought, surely, if there's so much money, which is going to basically eat the lunch of the subprime or higher cost credit card debt, that one thing that would happen would be the credit cards that have really been staying mid-market to high-end would have to shift down a level, and there'd be more credit supplied to the subprime or lower tier market. That has not happened. So you see credit card companies, even after this like mega deal between Capital One and Discover, Capital One stock is really, it has not been a great stock this year. It's up 20 something %, but that pales in comparison to a SoFi or a Rocket or even an Affirm. So it just is going to be very difficult to grow credit card loan balances because they're getting paid off so quickly. So I was absolutely wrong about the fact that I thought that credit card companies would say, we are not going to sacrifice earnings. We are going to lower or widen our credit band, go down market so we can expand balances and keep earnings on a roll. That may happen, but it hasn't happened so far this year. So in terms of where I thought that the economy would blend out, that hasn't happened. So what you see then is really I think you're going to see pressure with what we said, the avocado toast, but the low end is out of luck unless they have equity in their homes and they can access a new product from when we first got to know each other in the early 90s, which is a home equity investment or shared equity investment product. And the estimated market for that is about $1 trillion. So let's say the size of the credit card industry. That's subprime homeowners that can sell a portion of their home for a piece of cash, which may or may not be cheaper than a credit card loan. I think it's still a very small market, but I think you'll see more growth in that area. But interest so far as a firm, the reason why I turned positive on a firm was because they got a forward purchase agreement with I believe it was Atalaya 6th Street. And that just means that they become an originate and sell model. So they don't have to hold the loans on their books. Similarly, like with SoFi, they're basically they've cleaned up their credit profile because they can just originate and offload it. And the music stops when either the securitization market closes or private credit stops buying their paper. But what the originators are saying is that they cannot keep up with the demand from private credit. They can't originate enough to keep up with the demand from private credit. And because private credit is longer duration capital, I don't see that changing anytime soon. So the risks, you're absolutely right. The risks of subprime still exist, but they got a get out of jail free card because of private credit.
Well, it's a K-shaped economy and it's a K-shaped business environment too at the same time, because to your point, if those are the people that are providing the money, it's not your traditional cap ones of the world, which aren't dipping down. This money has to find a home, and it finds its home obviously lending or buying these assets from these companies that are originating. And if you're right on your thesis about the consumer, then at some point, that's my point, at some point this will turn, because we don't even know what the loss sharing arrangements are really between kind of these lenders, right? So you don't know. Yes, they might not have to keep as much on their balance sheet of your firm, but at the same time, believe me, when the music stops, whatever, things will get, obviously, like we saw in the mortgage crisis, things will start to bubble up a little bit and things will get stuck in the pipe, so to speak. So that's certainly something to watch there. Meredith, what other policies that are out there right now that are shaping your thoughts? Because never has it been this crucial to really understand all the things that are happening, maybe that I have not touched on here today, whether it's mortgage finance or some stuff with the consumer and insurance and Medicare, Medicaid, things that we aren't really talking about here. Is there something else on your radar here that we should be paying attention to?
I'm sure it's appreciated, but the fact that the CFPB has basically been taken out behind the woodshed and doesn't exist means that for financial companies, things just get a lot easier, because all you have to have is one friendly state regulator. So when so much of the regulatory onus goes to the states, then people just arbitrage the states that they're active in. And, Maryland is not a friendly state. New Jersey happens to be a friendly state. California happens to be a friendly state. Florida is a friendly state. So the lenders will just arbitrage and go to the states that are most lenient. It's almost like way back in the day when I used to cover subprime finance for Steve Eisman. It was all about where you were active and who had the most liberal usury laws.
Yeah, listen, that's the other thing, right? So people are like, oh yeah, get rid of the CFPB. Well, consumers that have been rooting for that would be the Consumer Financial Protection Bureau, which was obviously set up post Dodd-Frank and during Dodd-Frank and post crisis, is there to protect you. And to your point, these companies, again, another reason to own them, so payday lenders and whatever, is that they're not going to have the same usury laws and or people not going to have the same oversight, I should say, that kind of watches over them. But here you are again, Meredith, talking about wage garnishment potential, right? All this other stuff, debt collectors, which are publicly traded companies that we know of. It's going to be a really interesting cycle when those things start to happen without the CFPB in place to protect the consumer. And it's bad for the consumer. Might be good for corporate America, might be good, but it's something I don't think that people are paying enough attention to.
Yeah, so I think that you're going to find out. So just as you asked me sort of how long do you have for the rubber to meet the road on credit, the same thing will be consumer protection. So I think we're 4 or 5 years out. And when the rubber meets the road is when people start losing homes again. And you'll see, you see bad credit metrics bubble up, certainly in student and in auto first to a certain extent, not so much in credit cards and definitely not in mortgage, but you may see that, but the prepay speeds will pick up again because they'll just roll we haven't even gotten into the cycle where people are really rolling loans. So you're going to have to just hold your breath and, have steam coming out of your ears for a few more years, because I know this drives you crazy.
Yeah. So let's talk about this Meredith Whitney Advisory Group that you started after years on Wall Street. It's the culmination of everything, right? In terms of you were on the buy side, you were on the sell side. You did this consulting thing post financial crisis before. Now it's all kind of come together, and you cater to all investors, a ton of institutional investors, retail as well. What feedback are you getting from those investors right now, and what are you telling them specifically within sectors and maybe certain stocks that they should be owning or not owning at this point?
Well, we've had, you prepare a lot to get lucky, and this has been an incredible year. The stocks that, we've recommended to clients have been parabolic. So going into, starting from September 24, SoFi and Rocket have been what were our biggest pushes. I thought that this was sort of the fat pitch you get very rarely, and this was a fat pitch, and this comes into all the liquidity that's going into the consumer finance space. I didn't see Mr. Cooper deal, which obviously was a huge bonus for that. At the end of in November, I went from being negative for 3 years on the dollar stores to being positive on the dollar stores, and those stocks were up 50% from over 50% from 50% from November to May, when I went neutral on the dollar stores, because I thought that the weakness from Liberation Day and the weakness from ICE raids, and also the weakness from really the 52% of households that are living paycheck to paycheck would start to weigh on the dollar stores again. And those stocks have faded since then. They went up and then they faded back since then. So that timing was fortuitous. I still like all of those names. Another incredibly fortuitous call we had was right after Liberation Day. So Liberation Day was on a Wednesday. On a Saturday, I thought, like, how is this? What's happening here? How do we get out of it? How does Congress pull this back? And I called a friend of mine who happens to work with the most preeminent rare earth metal specialist in the United States. And he called my attention to what China did on the Friday night after Liberation Day, which was ban all rare earth exports. And so in doing that, I started going down a rabbit hole and found Mountain Pass MP Materials. That stock's up over 300% since then. So I pushed that on that Saturday. That was not on anyone's radar screen. China's move to ban rare earths was not on anyone's radar screen for about 2 weeks, and in that time I spoke with the administration about it, and the rest is history. That's been incredible. So I think that all of the government investments are going to they're going to go out of their way to make investors look good co-investing with them. So that's been another one, which I am still very positive on. And I'm doing work on others. I haven't focused that much on the banks, because the banks have been financial engineering, and they've done not as well as the picks that I've had. So I'm always looking for new ideas, but a lot of these ideas continue to play out.
So within the banking sector, we can end with that, since obviously that's your right in your wheelhouse. They act like utilities, or they did for a while. Now they're acting like tech stocks. But IPO market open, M&A is obviously happening, deregulation, et cetera. While there might be nothing to do there, private credit has replaced them on kind of the lending side, right? And we've talked about this last time you were on, and it's still growing. Last baseball reference of the day. What inning are we in kind of the private credit, as private credit works its way into retail? And what would you tell individuals that all of a sudden are getting access to these kind of sophisticated high-fee products that are now entering?
Those are two separate questions. I still think I still think we're sort of mid innings for private credit. I don't like the idea of retail being in private credit, because your money's locked up for 10 years. And unless you have a very high net worth, which are already in private credit, but retail, average Main Street people life's too hard. That lockup is going to be really potentially really painful for people. But it's a free market. People can do with what they want. There have been better returns over the last 10 years, but over the longer cycle, time will tell. I don't love that idea.
I mean, I would rather own the parent companies themselves of the ones that are producing the loans. You can own Apollo, you can own Blackstone, you can own KKR.
Exactly.
They've converted from partnerships to normal companies. So you're not getting a K1 anymore, and they pay a dividend.
Right.
Right. And so to me, it's like these people that are buying these crypto treasury companies, just buy the underlying crypto if you like it so much. Why are you paying a premium, right, for this other thing? So it's kind of, you're right, it's some type of financial engineering. So Meredith, so where can people find your stuff? Obviously, I have a nice in with you, but on your website.
Meredith Whitney LLC.com. And I welcome everybody. It's been really fun.
I think it's going to get, even if you want to call it more fun, I think things are about to get really interesting in terms of, we haven't had a real cycle, so to speak, for a while. And we didn't even get into gold because I know you don't really focus on that as much, but I know you pay attention to macro factors that are telling you that something's not right in terms of the dollar being this week and the gold, and you have to factor that all in. But certainly we're going to have you back on here, obviously, in a few months. And congrats on everything that you're building and the work that you're doing. And I think we're going to see a lot more of you. If I'm right about what's going to be happening in this world, and it's great to have your voice out there for all of us, Meredith. So thanks for coming on the pod.
I always love talking to you, Danny. Thank you.
All right, time for my NFL picks. Week 4, crazy week last week. Block kicks, fantastic finishes. I benefited from one of those in the Eagles game as they returned a blocked field goal for a touchdown as time expired. Love covering like that. Squeaked out a win with the Chargers because I had 2.5, and got CeeDee Lamb'd in the Dallas game. He's also my fantasy team, so that's a double whammy. So I was 2-1 last week and making my record 4-4 on the year. Nothing to write home about, but let's get better from here. So 3 games I like this week, all on 1 p.m. on Sunday. I can't believe I'm doing this, but I'm taking the Giants at home against the Chargers, getting 6. Seems like a decent amount of points to me. Chargers flying east for a 1 p.m. game. Justin Herbert has actually never played against the Giants in Giant Stadium. He played against the Jets, obviously beat them a few years ago there. But they had a knockdown drag out against the Broncos. I mean, Giants are in go-for-broke mode, whether Russell Wilson plays or Jackson Dart gets his first start, but give me the Giants +6 as home dogs. Dan Quinn returning to Atlanta as head coach of the Washington Commanders, where he was fired in 2020, bringing the Commanders in as 2.5-point favorites. Falcons look completely lost against the Panthers, and the Commanders' defense won't make it any easier. J.D. Daniels is probably not playing, but Marcus Mariota, who actually played for the Falcons, seems to be a reliable backup. A lot of storylines in this game, including Kirk Cousins is the backup in Atlanta. I wouldn't be shocked if he gets in. He was obviously drafted by Washington way back when. But Penix, I don't think he can do it. Give me the Commanders laying 2.5. And lastly, I think the Eagles found something late against the Rams and will carry that into an injury-ridden Tampa Bay team. Mike Evans pulled his hamstring, and Godwin might come back at receiving, but I just don't think it's enough. They have too many injuries. Both teams are 3-0. If I have to pick one team that's going to go 4-0, it's the Eagles. So lay the 3. If you have to buy the half point to get to 3, definitely do it. So those are my 3 picks. By the way, what a weekend ahead. We got college football Saturday night with Alabama at Georgia and Oregon at Penn State. Ryder Cup starting Friday, goes all weekend. Europe now +170. Seems like a decent risk reward to me. I will see you guys next week for another episode of On the Tape. Thanks for listening to the On the Tape podcast with Danny Moses. If you like what you heard, please subscribe on either Apple or Spotify to the weekly podcast, and please leave a rating and review, positive only. You can also watch on the On the Tape channel on YouTube and give us a thumbs up there as well.